Well, that's right, Kelly. And we all had an anticipation of a correction, especially after the robust 2021 that we had. But the severity of the drop and the rapidity of it, how quickly it happened, if you look at those charts, things have been relatively mild the second half of the year, but the first half was a devastating drop. We hope that this recent trend we had of choppy, directionless, certainly not a robust positive bull market, but at this point, we'll settle for choppy, finding a bottom, settling out,
Sure.
and then hoping mid-2023 offers a little more optimism.
You think, and I feel like you're right in this, you think the key is going to be wage growth. So kind of what I hinted before, the job market's still quite strong. Look at jobless claims. They're still basically fine by historical standards. What does that tell you? How does that illustrate the quandary we're in?
It's a quandary for Jerome Powell because oil prices have leveled off, commodity prices have come down, the supply chain is working out, you're getting discounts at furniture stores and all those goods that we had driven up in price. But what's not coming down are wages. And he has said as much, that they are not going to relent on their anti-inflation push until he gets indications that wages have been suppressed, or at least at a normal run rate. I know that sounds cruel, and it's unfortunate for workers who are finally enjoying wage gains, but wage gains are bad for inflation, bad for corporate profits, and not good for stocks.
Yeah, so where does that leave you in the market then? Bob highlighted some of the sectors that everyone wishes their whole portfolio was just marked this year. Where are you for 2023?
Well, we like financials, but I think people need to slow down and ask, well, there's a lot of different types of financials. And when I look at the risk of a recession, I don't think it's going to be a deep recession, but if there's a risk of recession, I don't like banks as much as insurers. Both benefit from higher rates, but insurers don't have revolving lines of credit. They don't have consumer loans. Their debt is long assets in real estate, well thought out, we hope, but well thought out real estate that can navigate the office glut. And they're anchored in long-term assets, not subject to short-term economic cycles. So higher rates benefiting their huge bond portfolios, finally giving them a rate of return, and they can avoid the recession shock that consumers feel, that banks may feel.
And we'll talk about this next hour, and they're raising prices, and, you know, that could, again, flow through to the bottom line. So you like insurers. Where else would you be? I mean, and are there areas, obviously we've seen the correction in high valuation tech stocks. Are there areas in particular you'd stay away from? What would you do with energy, for example?
Well, energy is, I think, mostly a rearview mirror. I don't think it's a bad trade. I think it's going to normalize and be more of a market player. It's interesting, the breakout between oil prices and the oil stock prices is at a relatively high range. So with oil stocks higher than the commodity, we wouldn't dive into that.
Yeah.
I think other areas we like, it's interesting, this is one of the few times in my memory that Democrats and Republicans are agreeing on increasing defense budgets. The Democrats have hitched their wagon to supporting Ukraine, and Republicans traditionally are supporting aerospace and defense. And that's an area that, given the massive spending we have in this budget for those areas and what we see happening and countries getting really nervous about drone warfare, we think the aerospace and defense sector is poised to benefit.